All right, guys, welcome back to the Independent Investor channel. On my channel, I really aim to strike at the core of what's going on in the investing landscape. And over the last couple of weeks, we've been in an obvious time frame of volatility. And I by no means profess to have all the answers, but I think especially my subscriber base will benefit to understanding what some of my activity over the last couple weeks have been. So you're going to want to stick around for this video. I'm extremely transparent on this channel, and I try to kick over all the rocks of all the defensive strategies that I've learned and evolved to know over my 2 decades or more in investing experience. I've been through this before, and I can tell you again, I don't have all the answers, but what I can tell you is I'm not selling, okay? And in an environment where there's a lot of what seems to be panic selling going on, I can tell you, and as I work through this deliberation, you're going to find that my decisions are extremely well thought through and actually very, very well planned. This is something that as a steward of the stock market, I pay attention to stocks that I own, stocks that I cover. And you're going to find when I go over the stock purchases that I made through the volatility, you're going to find that there's probably a lot more fundamental or underlying reason as to why I entered back into those positions. So this video is going to be how to profit in volatile markets, okay? And a lot of people are going to question how that's even possible. I'm off about 18,000 in the portfolio. It's really not one of those things I pay too much attention to. I'm really working hard right now to understand how I can place my positions in the portfolio for future gain, and it will eventually pay off. There's no doubt in my mind. The moves that I've made over the last couple weeks, which I'll chronicle here in a second, they will pay off, no doubt about it. In the short term, there may be more volatility to come. I don't know. But I've always professed that if you can build your portfolio and make your decisions to profit in an up or down market, you're understanding one of the key fundamental principles to not getting emotional over the short term and always staying long on your program. So the first aspect of the portfolio that I do want to cover, I'm going to throw out the stock picks for you guys that I've actually either initiated new positions in or added 2 existing positions in the portfolio to strengthen those positions. The first is 3M. 3M has been on a really multi-month, if not going on about a year, downturn. They had a bad quarter about a year ago, and it put them into a downturn. And I think this round of volatility over the last couple of weeks has really pushed 3M to an oversold condition. I had a starting position, and there's a reason why I do that. I had a 10-share position. Last year, I increased that position 10 shares. I've just recently increased that position another 10 shares. So the real takeaway here is not to say that I'm being impatient. I know that's some of the language that's going around in the market, is that you don't want to get in too quick. I do agree with that to an extent, but for 3M that's been in what has been a 1-year swoon in the stock price, I think here at 150 that triggered another buying opportunity for me, and went ahead and added to an existing cornerstone in my portfolio, and I was glad to do it. So 3M was one. Wells Fargo was another one, a double up position. It's trading at about 10 times earnings right now with about a 5% dividend clip. Wells Fargo has really just been kind of a drag to own over the last 3 or 4 years from the account scandal. It really has struggled to recover. I do think that that will wash out. It is the largest bank by bank locations in the United States, which is intriguing enough. But Wells Fargo is one of those dividend financials in my portfolio that I really do enjoy owning. My cost was about $49 a share. So with this swoon back below 40, I don't think I got it below 40. I got it for around 40. I was able to take another 50 share position in Wells and go ahead and double up that position. So we're sitting at about 106 shares in Wells. Glad to do it. Another cornerstone in the portfolio. It'll be fine as it continues to recovery on this multi-year recovery in Wells. Walgreens Boots Alliance was one of those Dow components that I've always wanted to own. It actually hit a trigger on valuation here at $50 for me that I was able to initiate a starting position in Walgreens Boots Alliance. I was glad to do that. So that's a new position that I've taken. I've liked some of the acquisitions. I believe they acquired 𝑪𝑎𝑛𝓋𝑎, I believe. Don't quote me on that. But in my research, I was following the acquisition that they made and was glad to go ahead and take a nice position in this fine dividend-paying company in Walgreens Boots Alliance, as I think that business is fantastic with the convenience of the pharmacy business and with the aging population. I think Walgreens is a steal here at 50 a share. UTX is a unique one. It's going to be going through a transition as talks to merge with Raytheon come to a head. They're going to split off their three businesses with Carrier and then their elevator business, and of course their aerospace business. They're going to merge with Raytheon. UTX has been a long-standing holding in my portfolio, but I have increased the holding. I wouldn't call that a double up in there, but I have added probably 20 shares or so to the United Technology position. I was glad to do so. So you can kind of see a pattern here. These are positions that I've owned for multi-years and have just decided to go ahead and add just a little bit to them, not to get crazy, but looking to take advantage a little bit of recessed stock prices in these companies that I know will recover over time. There's no doubt in my mind. If I'm wrong, I'm wrong, and I'm prepared to be wrong, but I'll probably be right, okay? The next one is Exxon Mobil. I took a double up position at 50. Again, another multi-year stock that's just been drugged down with the energy sector. There's going to be folks that disagree with me. That's fine. You're absolutely free to disagree with my assessment on Exxon Mobil. I've been glad to hold the stock, honestly. I would have liked to have seen a little bit better share performance, but I think, you know, oil's trading at below $25 a barrel. Recessed prices from when we went there a couple years ago, and here in the mid-40s, I think it's really kind of unfair and, quite frankly, arguably an oversold situation in oil. So I took a stab with Exxon Mobil to go ahead and double up that position, lower my cost basis, and hold it for the long term. I'm happy to do so. Citigroup was actually an interesting one, a channeling move that I made. I did sell the stock in the mid-50s. I was able to liquidate it at the market highs in January. I was ready to move on and take good profit from Citigroup, and I did, and I had moved on. And the partial, the dividend payments, the partial shares remained in the account, and that was fine. It just remained there, and typically those will roll out of the account within a month or so. But during this volatility, I've noticed the stock really come back, and I believe it got into the single digits on valuation in Citigroup, and nothing's changed fundamentally with the business except for the interest rate reduction of 50 basis points. And I do think that that in the short term did affect financials. However, we're talking about a globally diversified financial company. It's one of my favorites to own, and really trading out of the stock in January was more of a positional move and an ability to lock in profits more than a trigger point that I met in Citigroup to actually sell the stock. So I reestablished the position at 60. So just a perfect example of a channeling opportunity. And you'll find throughout these examples, you know, I know that there's a carpet bomb of explanation that we don't want to jump into the market too fast and be impatient with our decisions, but you got to strike where the iron's hot. And I did so on the sell side, and I believe I'm doing so on the buy side as well with Citigroup, reestablishing the positions. Those partial shares remained in there. So the 35 shares or so, I guess, that I added into Citigroup, as a matter of fact, I think it's about 65 shares. I bought Citigroup in two different increments. I bought it in a 30 share block, and then a 35 share block on the really big red days. So established a nice position here at 60. I'll be glad to sit on this fine name and watch that appreciate back up again. So basically a channeling opportunity, a swing trade opportunity per se. It was one of those companies that I owned for a while and built up a position in. Was glad to take profits, and I'm glad to re-enter the stock now. Very simple deliberation on Citigroup. The final one that I mentioned, and there are many more in the portfolio, Apple, Microsoft, some of the bigger ones that have come off of their historic highs. We've added a little bit to those positions. I will just disclose that to you. So this is not an all-inclusive list, but I thought that this list really demonstrated a little bit more of an in-depth explanation as to what I'm thinking with my single stock positions and positioning, and not so much that I'm rushing back into these positions by any means. These are long positions to me anyway. So buying them here, you know, off their all-time highs of January, to me, is a good entry. They may continue down. We may do a V recovery and recover. I don't know. But for the long term, I'll win either way, and that's what I'm interested in. The final name I will offer is Caterpillar, one of the premier industrial plays in my portfolio. Fits in with my profile of really insisting on having a nice industrials exposure in the portfolio. I could go on with a list of 50 other stocks that probably fall into the buy category. You know, I really like Berkshire Hathaway right here. I like the opportunity with both Morgan Stanley and Goldman Sachs. Bank of America, honestly, at 26, probably could be a reestablishment position. I could go on and on and on, guys. And if there's some companies that you're really interested in, the most obvious right now that are the most affected by the volatility being the cruise lines, which are phenomenal businesses, and the airlines, which are also very good businesses. They all have good balance sheets. They're as strong as they've ever been. And they're just being punished right now in mid-single-digit valuations on the airlines. So a lot of opportunity right now. And again, I'm not saying that you go rush out and buy these names, but the reason for this video is to kind of understand the deliberation that I went through to either establish new positions with scale or add to existing positions that I had already had in the portfolio for years, and I'm just maybe looking to take advantage of, lower my cost basis, all the while on each and every one of these names being paid dividends and accumulating my share base, even through the volatility. It's very important to not miss out on acknowledging that very fact, okay? That rounds out the stock aspect of my repositionings or defensive positionings or looking to profit during volatile markets. The next is the ETFs. I had declared over the channel that I want to go for a 50-50 split in the portfolio because I can't really determine for myself which of the two strategies is better for my own risk profile. So I'm doing a 50-50 split in each of the portfolios, a nice diversified base of ETFs in the portfolio. I've established a 100 share position in VOO, which is my favorite S&P 500 ETF. I'll be glad to just own that, have that growing, tax-protected, wealth-preserved dividend reinvestment inside of the self-directed Roth IRA account, and I will live to fight another day. Again, if it never returns to the share price that I bought it at here at 43 years old, then I'll give it to my kids someday and let them enjoy that appreciation on that nice, sizable, respectable position in the S&P 500. I've also rounded out my position in the international total market, which is VEA. 100 share position there as well, rounds out a nice position there for my domestic exposure and my international exposure to boot. Okay, I'm not going to get into details of those, but over the course of the last round of volatility, I've been basically buying 10 share blocks of the ETFs to basically inject when I thought the market was at its low and to go ahead and round out that 50-50 split of exposure. And I'm right on it right now. I'm very satisfied with this opportunity that I've been given. You know, it's been a 2-week gift of down 4,300 points on the Dow. So I step in calmly and I make my moves, and I'm satisfied now going into whatever volatility the stock market can dole out over the next couple weeks, or it can recover. I really don't care, to be honest with you. I'm just thankful for the opportunity that I've been given, and I don't speculate on where I think things are going. That's irresponsible and quite frankly not possible. All right. The 401k is worth mentioning. I'm not going to get into details on, everybody knows that I'm part of the TSP. A lot of people don't know what that is. It's a 401k-like program. But for those of you out there who do have your 401ks, some of the things that you can think of is to maybe increase your pressure right now. I've said before, when the market was at an all-time high, maybe that was a potential to maybe throttle back on your exposure. If you're having problems meeting certain budget obligations, that's not a time where you want to have your foot on the accelerator. Well, now we've been provided an opportunity to maybe press a little bit harder and maybe upshift on your opportunity. That's all. I'm going to do it myself. I had some cash to the side in some fixed income products. I've since repositioned that portfolio. Again, it is very passive and very long in my 401k. So I've went with a 70-15-15 split, 70% S&P 500, 15% international exposure, and 15% small cap exposure, all equities exposure. We are all in 70-15-15 split. And I will just add this. If you have an existing 401k and you don't pay a whole lot of attention to it, there are a lot of different things you can do to really take advantage of this opportunity in the market if you choose to do so. Increasing your contributions, making sure that your allocation is set the way that you want it to take advantage of a potential rebound. And so worth looking at and making sure that you're looking at it and making sure that you're happy with your current positioning. The last thing I'll mention, because I know a lot of people know my position on cash, I am an advocate of. I've went through a lot of different series in my life where it's been frustrating not having cash on hand. Cash on hand right now sits at about 33% or so, about $100,000. I'm still sitting on it. I'm not going to say too much about that other than it's there and it's my sleep easy money. And win, lose, or draw on this thing, I'm very, very happy with continuing to fund and using my cash as a repository for inflows of certain injects in my life, one of which I'm going to mention now, okay? So just in recap in this video, I kind of want to go through the 5 strategic things that I've done through this volatility to really help maximize my potential profit down the line. It's hard to articulate how some of these positioning moves will pay off into the future, but I can guarantee, given good due time, I will absolutely look back and be proud of the fact that I did everything that I could possibly do within my power, right? Everything that I had prepared to be able to do during the last couple weeks of volatility. The first is that the Roths are funded for both 2019 and 2020. We are done. The $6,000 has went into each of the Roth IRAs. I would encourage each and every one of you guys that if you're looking at the opportunity to take advantage of a little bit of a downturn in the market, you could certainly fund that. If you're not satisfied with making the move to equities or bonds within your Roth IRA account, you could certainly hold that in cash. But make sure that you're making that funding to the Roth IRA if in fact you do have some left to make. I've already mentioned the 401k, continuing to monitor and where possible, looking to increase your exposure to your 401k. Right now, I'm at about 10%. I will be looking to actually probably double that over the coming months and weeks as this volatility stays, and I'm going to be looking to inject more money into my 401k program and then monitor as this thing continues down, or if it shorts and turns back up again, I will withdraw that back again to where I'm comfortable at 10%. But definitely an opportunity to maybe start to press on the accelerator a little bit and add a little bit more to the 401k plan, all right? Revised plan for me is to scale back a little bit and to monitor my taxable accounts a little bit more carefully. I really want to be prepared on the cash side to make sure that I can guarantee my max funding schedule for years on end, and I can. I mean, I could max fund for the next 10, 20 years almost with the amount of cash that I have on hand. So that's a good thing. And that peace of mind that I have to do that is great. I'm not going to be so aggressive on funding up the taxable accounts. I'm going to make sure that I'm doing everything that I can do to get as much money strategically into the tax protected accounts and throttle back a little bit on the investing in the taxable accounts. Those investments aren't going anywhere. I'm totally fine with that. The M1 accounts and the first trade account. We'll continue to strategically grow those up on a drip, but that's it. I'm not going to be taking bulks of capital and putting it into those smaller accounts. I may look to monitor those accounts and maybe take a double up in the spider portfolio that I have with the sectors, but I'm just continuing to monitor, play my options, play my drip in those, and they're working just fine. The last thing I will mention is, you got to save your tax return. Everybody's probably getting their tax return. That went straight to cash for me. So just a psychological win there to take some of that cash and put it to the side to live to fight another day with that tax return. That was $4,000. Boom, right to cash. Those are the small injects that I'm talking about to where the cash account serves that purpose. And the last thing I will say to all investors, if you stuck around for this 20-minute video, is to continue to monitor your opportunities, okay? I'm continually evolving and I'm continually monitoring. I'm never afraid to make a move in the market. I don't set rules like, hey, I need to see the market down 20%. I don't think like that. I think along the lines of more of a rational investor in that we're down 13%. It's an opportunity for me to scale some of these positions in. I don't think it's erratic and I don't think it's being impatient at all. Again, through my explanation, you'll kind of understand some of the deliberation that these were positions that I was long on anyway and or took profits on here recently before the volatility, and it's really just revolving some of that profit back into the underlying stock at a cheaper price. So everybody can benefit from continuing to monitor and take advantage of, where appropriate for your own programs, the opportunities that are presented as they continue to roll out. Guys, thanks for tuning into the video. You want to make sure and subscribe to the channel. Leave your comments at the bottom of this video and share this video with anybody that you know that may be struggling a little bit with the volatility. Remember, we want to eliminate all emotion in the stock market, man. It'll help you long term. Really, what happens in the short term really has no consequence whatsoever, and it's really, quite frankly, meaningless. Guys, thank you so much for tuning into the video, and good luck in your investment future.